Hi everyone, Kara here. I have a special guest with me today. This is Chris Fountain. Chris, can you go ahead and introduce yourself real quick? Tell us what you do, how long you've been in the industry, and maybe like a fun random fact about you.
Yeah, absolutely. So my name's Chris Fountain. I'm a loan officer here in Houston with a company called Bay Equity Home Loans. I've been in the industry for about 5 years now, doing lending. Before that, I was in financial planning. And fun fact about myself, I also have a small pasta sauce company here in Houston.
Yes, I am so excited to try that sauce. Chris and I met this week and he actually gave me some, so I'm really excited to put it into a recipe this week. We're so excited to have you on here. As you know, because you are involved in this group, you're answering questions and commenting throughout the day. But this community is full of people wanting to move to Houston. So you don't have to tell us specifics, but you live inside the loop. Is that correct?
That's right. Yep, I live just outside of downtown.
Awesome. So when we say inside the loop here, that means that it's within 610. So Chris, are you in the Heights or is it considered something else?
I'm in the Heights.
Okay. So in the Heights, I mean, there's fun food. There's tons of like wineries, or not wineries, but you can go get wine and there's trails. There's all sorts of things out in the Heights. So if you ever have questions about the Heights, let us know. Chris lives there, so he could probably give you some really good insight. But today
Tons of
we wanted
recommendations.
to, yeah, for sure. We wanted to pick your brain because we get a lot of questions, Kelly and I, about the pre-approval process, or what loans can I qualify for, or can I even buy a house? And we're able to share, some details, but we're not lenders. So we want to have you here to answer those questions today. And y'all, at any point, if you have a question for us, go ahead and comment below. Kelly is actually managing our comments today. She's going to chime in if anyone has a comment, and we'll just answer them live. But we're going to go ahead and start out with some frequently asked questions that Kelly and I see on here a lot. So Chris, tell us, what are the different types of mortgage loans?
Yep. So for about 95% of people out there, you're going to fall into one of four categories. So the most common loan is going to be a conventional loan. That's typically going to be someone who has a credit score minimum of about 680. With conventional loans, you can do as little as 3% down if you're a first-time home buyer. If not, you can also get away with doing 5% down. Second most common loan is going to be an FHA loan. So this is when your credit score is below 680. Still a really good loan, very popular. It's probably about maybe 4 out of every 10 borrowers that I work with go FHA.
Okay.
With FHA, you can do a down payment of 3.5%. Other two common loan types, we've got jumbo loans. So that's for any loan that's going to be just over 620,000, kind of falls into its own special category. And then, I'm sorry, 640,000. And then we've got VA loans as well for veterans. So these loans are a little more specialized. You can go 0% down. You can use them multiple times over your career. But those are really the four main types of loans out there.
Awesome. I love when you hit on the VA loan because I feel like not a lot of people know about that one. And when they qualify for it, I mean, that's such an exciting thing. You don't have to put anything down. You can go straight into your new house. So kind of playing off of that. So you did hit on this. So mortgage loan qualifications. I know you mentioned credit score, but what about like work history? What about the amount of money in the bank? Types of things like that.
So it all kind of depends on what your employment status is, whether it's W-2 or a 1099, which is like an independent contractor, but it also depends on how you're compensated. Are you salary? Are you paid by the hour? Commission, bonuses, things like that. Easiest way to qualify for a loan is if you're a salaried W-2 employee. In that instance, you don't always need to have a 2-year history. Oftentimes you can qualify with less. Same with hourly employees. You typically don't have to have that full 2-year history as long as you're W-2. If we're talking situations though, where a client might be self-employed, they might get bonus income, commission, or overtime. To use any income like that, you have to have a 2-year continuous history of it.
Mm-hmm.
But let's say, for instance, you work at job A for about a year and a half, and you got salary and you got commission there. If you start a new job, job B, and now you've been there 6 months and you're getting salary and commission, that's completely okay. We can also use that commission income because you've got a 2-year history of receiving it. It doesn't matter if it's with different employers or not. It just needs to be continuous.
Okay, great information. So tell me about this, oh, actually, one second. So Eric, we see your question about your car loan affecting your DTI. We are about to get to that, I promise, and Chris will go into more details about it. For right now, so tell us, with COVID the past 2 years, everyone's working virtually. How does that play a part in maybe someone moving from out of state, but they're going to be with the same company virtually now?
Oh, so that's not an issue at all. Anytime
Okay.
someone is applying for a loan, we usually do something called the verification of employment, where we're going to reach out to either your payroll department or your HR department. We're going to verify not only that you work there, but when you started, your position is, and we'll look at your income for the past few years. They'll give us a full breakdown of it. If you are a virtual worker, we'll ask them to verify that. And if they say, hey, Kara is 100% remote, she can work anywhere in the country, she's still employed full-time, this is her pay, you're good to go. That's not going to cause any interruption whatsoever. Whether you just switch to virtual or you're starting a new position within your company that's now going to be virtual, that's completely fine.
Perfect. We're seeing that situation all the time. Like people are still, they've been working in New Jersey for the past 10 years, and now the company is virtual and they're like, hey, I can move to warmer weather. Why not do that, right? So they're moving down to Texas to enjoy the weather here. Back to the question of what is first-time homebuyer assistance and what other assistance do you offer?
For sure. So there aren't a ton of first-time homebuyer programs out there, but the benefit to that is you often don't have to be a first-time homebuyer to use these programs. One of the ones that does exist is called the Home Ready, Home Possible program. So this is for conventional loans. Typically for this program, you need your credit score to at least be at a 700. Not only does it allow you to do that 3% down, which a lot of people can qualify for in general for conventional loans, but it'll give you discounted mortgage insurance, which is also known as PMI. This is an insurance you're required to carry if you do less than 20% down on a conventional loan. But some other good programs out there is there are a lot of down payment assistance programs available in Texas, where you can take either 3, 4, or 5% of the amount that you're financing and apply it directly towards your down payment and your closing costs. We've had plenty of clients before come to the closing table with, on a $300,000 home, as little as, $2,000 to $5,000.
Awesome. That's great. Okay, so Eric, we're actually about to dive into DTI. So Chris, what is DTI? A lot of people in this group have heard that term, but they're not entirely sure what that is. And how does it affect their chances of qualifying for a loan?
So your DTI is just an abbreviation for debt to income ratio. Basically, we take all the monthly debts that are on your credit report. So this could be an automobile loan, it could be credit cards, student loans, anything along those lines. And we divide that, we add that to what your house is going to cost a month, and we divide it by your monthly income before taxes. So every different type of loan has a different debt to income ratio cap. For FHA loans, you can usually go up to about 57% of your gross monthly income. For conventional loans, it caps off at about 50%. And then for jumbos, it's usually going to be in about the 40% range.
Okay.
Different lines of credit affect your debt to income ratio differently. So for instance, a lot of people are oftentimes worried about their student loans. With your student loan, we're either going to take 1% of your student loan balance and consider that your payment, or whatever your credit report tells us it is. And in some circumstances, if you give us a letter from your student loan servicer, maybe you're on like an income-based repayment plan, which would give you an even lower monthly payment, we can use that instead.
Mm, that is great to know. Okay. And can you tell us about car loans, car payments?
Yeah, absolutely. So auto loans can sometimes make it a little difficult for clients to qualify for a loan, especially if they've got a very high car payment compared to their income.
Okay.
Reason being is that auto loan is going to eat into your buying power because we have to count it against you.
Right.
The good thing about auto loans, if you have 10 payments or less left on for how much you would need to pay until the payment is paid off. So for instance, if you have an auto loan of 10 grand left on the balance, but you pay $1,000 a month, we don't need to count that against you anymore. So 10 payments or less, we don't count it against you. When clients do have an auto loan that is just eating up too much of their buying power and it's interfering with purchasing a home, the first thing we're going to do is try to see if maybe they can refinance that car to get it a lower payment. That's usually step one. Step two, we could see, hey, is it possible for you to, pay off the car completely? If not, step three, is there any way you could trade it in and just for a different car at a lower monthly payment? Maybe instead of financing it over a 3 or a 5 year course, you extend it to 7 or 10.
Okay, so in
Yeah,
that
but
case,
just because you think you have high,
yeah, so in that
oh,
situation,
go
it's
ahead.
kind of like, do I want to purchase a home or do I want to stick with this expensive car payment? And usually I would think you'd probably go more with the home, but I mean, everyone's different, right?
Yep, that's true. Some people are, they love their cars, but
Yeah,
just because you have a high car payment, don't think it's automatically going to disqualify you from being able to purchase a home. We'll look at all the numbers and we'll look at the payment range you want to be in for when it comes to what you want your monthly mortgage to be and try to still fit you in of what's going to work best.
great. So Eric, I hope that answered your question. If it doesn't, go ahead and comment again and we can hit on that a little more. So moving
Oh,
on
one
to,
other thing I'd actually
yeah, go ahead.
One other thing I want to touch on, Kara, for everyone listening.
Mhm.
So if you do co-sign on a vehicle for someone, we do have to count that auto loan against you as well. So just be wary if you co-sign on a car for a family member, a friend, a significant other, we do have to act as if that car is in your name and you're the one responsible for the payments.
Okay, that is good information to know for sure. So what I've heard a lot is I want to buy a home, but I don't know if it's possible for me. And so with that,
Mhm.
they're thinking, how do I find out? How do I know if it's possible? I've been thinking about renting, but I'd rather buy. What do I do first?
So first step is to talk to a mortgage lender like myself. The first questions I always over with a client before we do an application, credit check, anything like that is, what do you think the price range you want to be in is? If you're not sure about that, what's a comfortable monthly payment for you? If we're talking about, your mortgage, your taxes, your insurance, what's going to fit within your comfort zone? Oftentimes, if they cannot be sure about that either, and then we'll say, hey, what's your rent right now? Is that comfortable for you? Could you go higher if it meant you own the property, or would you actually like to drop that number?
Mm-hmm.
So once we kind of figure that out, we're going to help you tailor. This is probably the price range that you should be in realistically based off of what you want your monthly payments to be. And then we can get into the nitty gritty of, hey, let's look at that credit report. Let's see if we can qualify you for a loan. Talk about the pain points or the fears that you have, why you think you might not be able to. And just because you can't right now doesn't mean we can't help you set you up on a plan so you can buy maybe 6 months or 12 months from now. We have plenty of clients that we help them build plans to increase their credit, maybe build their down payments, help them figure out how to restructure their income to where they can eventually qualify for a loan.
Great. Okay. And so tell us, what's the difference between pre-qualified and pre-approval?
Yep, that's a really good question. So we get asked this all the time. So think of like a pre-qualified as if you were to, talk to me about what your finances look like and do an application with me, I could say, hey, in my opinion, you're pre-qualified. So your file looks good to go. I don't see any reason you won't be able to buy a house. That doesn't really go very far in today's market anymore. You definitely want to be pre-approved at a minimum. Pre-approved means I looked at your pay stubs, maybe your tax returns, bank statements, W-2s, your credit report, everything. We had it all reviewed and we know for a fact you're good to go moving forward. We don't see any issues based off this information with you qualifying for a home. Sometimes you can take it even a third step further, which is where we'll pre-underwrite a file. This is where not only myself and my associates reviewing your documents, but we're sending them into corporate to get everything reviewed by our underwriters, the people that would actually be reviewing your documents once you sign a contract, to look for any red flags, anything you might be or we might be worried about. So I would say you absolutely want to get pre-approved. You've probably seen it yourself right now. In today's market, most sellers won't even let you come into a house without having a pre-approval letter.
Exactly. There is so much traffic coming in and out of homes these days. They're trying to qualify people themselves. And so when I'm working with buyers, I mean, we're not even looking until they are pre-approved because we don't want to spend our time looking at a price point that's not going to work out. And then, we've spent 3 days looking at houses and they're not pre-approved for that price.
Mm-hmm.
So most definitely,
right.
When y'all are coming to Houston looking for homes, I'm going to make sure that we get pre-approved for you, whether that's with Chris or a lender you choose. And that way we are ahead of the game. We know if you find something that you love, we're able to submit an offer because we know exactly how much the loan is for, and we will submit the pre-approval with that as well. So it is very important, especially right now. And so tell us, Chris, how long does it take to actually get pre-approved?
It depends on the situation, but I would say on average, from the time you give us all your financial documents, pay stubs, W-2s, things like that, usually only about 24 hours. It can sometimes take a little bit longer, maybe 48 to 72, if someone is self-employed, maybe having trouble locating all those documents, or has a really complicated income structure.
Right.
But for most borrowers out there that are W-2 employees, salary, overtime commission, even things like that, usually only about a 24-hour turnaround time.
Okay, great. And so what happens after, we go under contract? So me and my buyers, we're looking at a home, they find one they love, we've written a strong offer and it's accepted. So from the loan process side of things, what happens from going under contract to actually signing at the closing table?
For sure. And before we even jump into under contract, let me talk about a few of the steps before that.
Yeah, go ahead.
So the very beginning is a client approaches, you, for instance, Kara, and they're like, hey, I want to purchase a home. Step one is to send them to me. We do the pre-approval. So we do the pre-approval with the client. We figure out what they're approved for, help them figure out, is this a comfortable zone for you? And then they go out and start looking at homes. Once they sign the contract at that point, then that's when they kind of go from looking at homes with you to coming back to our side of things, where we start working on the finance aspect again. So from here, we're going to schedule a meeting. We're going to go over quotes on the specific property you signed a contract on. We'll present a couple different mortgage options to you. We'll say, hey, here's this down payment. Here's a lower one or a higher one. Maybe there's some discount points with this option. So we'll show you a couple different options, figure out what's going to be best and most comfortable for you. Once you decide on that, we're going to go ahead and do what's called locking in your interest rate. So at that point on, your interest rate is locked in. The only way it changes going forward is if you eventually refinance the loan. So locking in a rate essentially protects it from any market changes, which is really important right now. I'm sure anyone watching the news, you can see interest rates are kind of jumping all over the place. So it's good to play it, safe and get it locked in when you can. After you lock it in, we're going to take all those documents you initially sent us for your pre-approval, and we're going to submit them to the underwriters for official review. We're going to order your appraisal. We're going to get your survey ordered, get all the title working. It's about anywhere from 21 to a 30-day process. And at the end of it, that's when, hey, you're what's called clear to close, which means fully approved and the house is yours.
Yeah, that's the exciting part.
Yeah, that's the fun part. You get to take the photo with the big key.
Yes.
But in between that time, we're constantly updating you multiple times a week saying, hey, here's where your loan is at right now. We're letting you know if there's any documents we need from you that you might have missed or having trouble locating. We're giving you updates on here's what the appraisal came in at, here's what the title company needs. So you're well taken care of and you get a lot of communication. You're never really going to feel lost in a transaction.
Right. Yes, that is great. And what I typically tell whether they're first time buyers or experienced buyers, I always recommend them work with a local lender. So Chris is a local lender. He lives right in the middle of Houston. I mean, he has a cell phone number that I can pick up and call. And like we had lunch this past week to catch up on business. You want to have someone that is reliable. And I mean, of course, a bank is an option, but you're going to have the 1-800 number and you're probably going to wait on hold and get someone, a different person every time you call to talk to. Whereas if you work with a local lender, Chris has the details right there, and call him up, text him up, and he's following up all the time. Because when we go under contract, the agent and the lender are in contact the entire time, making sure everything is ready to go. Chris, hey Kelli, we're having a lot of feedback. Can you either mute yourself or turn down your stereo? Stereo.
Is it
like
gone?
we're in the 90s.
Still there?
I'm not sure. I'm going to keep talking. But I mean, looking at a local lender is definitely a perk in this situation. But going off of that, so I think that's everything I have here. Let me go ahead and look in the comments and see what we have. So Eric said, thanks so much. He appreciates our answers. But he also said, can you qualify with bad credit? So he might have missed the first part of this video, but Chris, maybe hit on that because maybe we didn't hit on it enough.
For sure. So the minimum credit score for an FHA loan, which is where I would probably steer a client if their credit was a little bit on the lower end, is going to typically be anywhere from a 580 to a 600. Now, if you are under that score, a lender like myself can usually work with you and help you figure out, hey, here's the pain points I see in your credit report. This is my recommendations of what you do. Pay down these accounts to X amount of dollars, maybe remove some accounts, come back in 30 so days, and we'll see how things look then. If the credit is past the point where I feel comfortable giving advice on it, I typically refer clients to a credit repair specialist. And we only have one or two people we refer to. They're both vetted out. They're the only people we send our clients to, and we make sure that they take very good care of people.
Good.
So because you have low credit, don't think you can't qualify. If you do eventually want to purchase a home, the first step is to get that credit checked by a lender. We'll figure out what's hurting it, and then we'll build a plan from there.
Great. And so we have another question. It says, what if I don't have the money for down payment, but my grandparents or significant other wants to gift it to me or let me borrow? Is that okay? Can I use my 401k?
Yep, so those are really good questions, and that's very common. When getting a gift just has to come from a family member. So a significant other, grandparents, cousins, uncles, children, anyone like that is completely okay. There is a certain way we handle gifts in terms of the actual structure of them in a mortgage transaction. So I always advise clients, hey, whoever is giving you this gift, that money needs to be in their bank account, as in the person who's giving you the gift, say it's your grandfather, that money needs to be in the grandfather's bank account for at least 2 months, because there is a chance we need to look at those bank statements for the grandfather. And if we see, oh, hey, there was recently a cash deposit of $20,000, that can raise, some red flags from an underwriting standpoint.
Right.
So money needs to be what's called seasoned in the bank account for at least 2 months. But gifts, totally okay. I always tell clients, just make sure the person giving you the gift keeps it in their bank account for right now. And then we'll walk you through the appropriate and the cleanest way to do that transfer. So that way those funds can be applied towards down payment and closing costs.
Okay.
And also borrowing from a 401k for a down payment, that's completely okay as well. And it's not treated the same way that a hardship withdrawal is on a 401k. So you're not going to get that crazy tax penalty. There's certain ways to do it though. We would have to get what's called your terms of your withdrawal for your 401k servicer. So if you work with someone like Fidelity, they can provide that document to you, you give it to us. And basically it just lets us know, here's how much you could pull out for purchasing a home. And this is what your repayment plan is going to be.
Okay, great. So Kelli, I'm going to ask you to close us out, but real quick, thank you so much, Chris. This is extremely helpful, whether people were able to tune in live or watch our recording later. I mean, you hit on some great points, great advice. And if anyone wants to talk to Chris directly, he has a phone number, not a 1-800 number. So I'm going to go ahead and share his link down below. It'll have his contact information and also a link to apply. So tell us, Chris, real quick, like if they click that link, what's going to happen? Are you pulling credit? Are you not? If you could share that with us.
So if you click my apply now link, we don't ever pull your credit before talking to you first, because we want to make sure we have all the correct information, figure out exactly what you're looking for before we go ahead and do that. And it's always nice to have permission before someone checks your credit. We can't get you pre-approved without checking your credit though. So do keep that in mind. You know, if you don't want to get it pulled right now because you're working on some things, maybe you're disputing some accounts or you recently opened up some new ones, we can hold off for now and still give you an idea of, you know, this is probably what your monthly payment's going to be or what your approval will look like just based off the information you're giving us.
Okay.
But if you click that apply now link and you fill out that application, once you finish it, you can be expected to be contacted by me personally within 24 hours. We'll go over the next steps and, you know, we'll start scheduling some time to build a plan to get you into a home as soon as we can.
Yay. And so I have a lot of people ask, but if he runs my credit, what's going to happen to my credit?
Yep, so that's a really good question. It's something I deal with on a weekly basis. So a lot of clients are afraid because you hear, oh, I get my credit checked and it drops by 20 something points. So getting your credit checked by a mortgage lender is not going to hurt your credit report. You can go ahead and get your credit checked by a mortgage lender, and then you get about a 2-week window to get it checked and play around with it a little bit without having any adverse effects. Where you might get your credit hurt if you get it checked is if you go and get it pulled, you know, 10 plus times. Sometimes we see this happen when a client is financing a car. Sometimes dealerships will pull their credit, you know, 8 plus times on the spot. That would have an adverse effect on your credit because to the credit bureaus, that looks like suspicious activity. But if you're just getting it pulled once or twice, you don't need to worry about a score drop. Nothing's going to happen there.
Wonderful. That will make a lot of people feel better, I assure you. Okay, Kelly, take it away. Thanks again, Chris. I really appreciate it.
Absolutely.
Great.
Thanks so much for having me on.